Is whole life insurance even good? Find out why real world investors Dave Ramsey and Suze Orman love whole life insurance and its many tax free and protection, asset protecting properties.
Like your
They're so
scary
filled of
voice.
it, they just love it.
Tell them who you are.
I'm Mark McKay, and this is Sage Smart Solutions.
And I'm Marcy McKay.
Today, we're going to talk about some of the common misconceptions and some of the real world limitations of whole life, and about what is whole life anyhow. And if it is so boring as Dave Ramsey and Suze Orman and I don't know,
lots of other talking heads.
A few. There's not that many because they realize how wrong they are.
Right.
Yeah. But then why is it so popular?
Right. Excellent point. So get into it. Why do Dave Ramsey, Suze Orman, why do they hate whole life insurance?
Because they don't make anything on it. There's nothing to do. It doesn't keep you up at night worried about, it is the most boring investment. I can make it where
Boring
the returns are exciting, but I have the types of investment that Suze Orman and Dave Ramsey are recommending you put your retirement account into. You know, every expert out there is now saying you should maybe not take out more than 3% during retirement from those types of an accounts, those equity mutual funds like Dave Ramsey is pushing. So do the math on that. But the reason they're against it is because it would be boring if you called and they looked at the math and they said, yeah, okay, well, if you do fund this and we ramp this up for the cash value in the early part of it and we maximize it for the tax-free growth and not the death benefit, oh yeah, you could provide a really predictable, nice retirement here. Okay, you lost 3/4 of your audience. It's more fun to make fun of people for having a car that they financed.
Right.
Dave has a $15 million home in Tennessee. So talk to me about financing my Mazda 626.
Over 900 people. But they also say buy term life and invest the rest. And that'd be great if people did pay off their debt. Add to
would
their
be
savings,
great.
But that's not what happens. The facts say people buy term and spend the rest.
Yeah, but even if they don't, I don't think they can match the returns that the big institutional investors that are investing the money for these whole life insurance companies can make. But you're exactly right. I grew up in an industry where they were saying, oh, you don't want to buy whole life, you want to buy term and invest the rest. So if to get $1 million life insurance policy was going to cost you $1,000 a month, they're saying, okay, take $100 a month, buy a short-term policy, put $900 a month into a mutual fund. They didn't bring up the fact the reason they're telling you this is because they're selling mutual funds. I worked for one of these companies. We had our
conflict of interest
our proprietary mutual funds. We also had we still have one of the policies.
Yeah.
It's been about 30 years, so it may go away soon. So it served its purpose, but boy, do I wish maybe we'd been socking money into a whole life policy over those 30 years. We bought a policy on Marcy when we first got married because the company I worked for that sold mutual funds said, hey, put the rest into mutual funds, but buy this term policy. Anyway, if you'd like to see on paper the math and how that works, it stacks up nicely. In a real world example, people don't do it. They don't buy the term and invest the rest. And if they do, then 3 years from now, like, oh no, well, I need the new veneers. Do people still get veneers?
Some people do.
So let's go. I don't know. That's a bad example.
They buy new, hot, cool pickup trucks.
Well, they find a reason to they rationalize not continuing. And so, 10, 20 years from now, the whole thing is there's nothing there. Whereas if they had stuck with, an infinite banking, a be your own banker, or even better, one of our leveraged whole life plans, they'd have a big pile of money that they could access with complete liquidity, tax-free.
Absolutely. So explaining whole life insurance in defense of whole life, give us some of the positive attributes. Number one.
Safety.
Yeah.
Safety. Suze Orman and Dave Ramsey make a big point. Whole life is not an investment. I don't know which one that is.
I know. I always like when you do the voices for whoever you don't agree with.
I'm not going to imitate Susie.
You didn't sound like Dave either. Don't do.
I can
No,
sound.
no, no,
That's,
don't.
that's
No,
pretty
no.
close to what he
Okay.
sounds like.
So that's number one.
I forgot. Oh,
safety.
so they make a big point that it's not an investment. Okay. When you think investment, what do you think? Are investments guaranteed?
No.
I mean, there are some, but when you think investment, you think risk.
I think stock market.
You think risk. You can think real estate. You can think precious metals. You can think the stock market, but it seems like risk. When you think a bank account, what do you think? Safe. Boring. So how do we fix that? We've got the safety that we want that we are lacking in the Dave Ramsey investments. Oh, but he tells you to get rid of all your debt. Explain this one to me. Dave says that without trying very hard, you can go out and get 12% on an annualized basis if you keep it in there. But then he also says to take on no debt other than your mortgage. You know, why would you not finance your car at 6% if getting 12% is so easy?
Right.
So.
Okay, so number one is safety. Number two, it's sort of best of both worlds. It is an investment, and it's also backed by an insurance
Well, I don't even
company.
care if you call it an investment. You call it a savings account, but we can set it up. And you know what they're looking at the old school whole life. I always say the wealthy leave clues, and I don't remember who I stole this from, but I used to play golf with my dad a bunch, and we'd go out. And he was a surgeon, and I'd go out there, and there'd be 3 or 4 surgeons in a group, and then this guy, and I'm like, who is that? No, it's it's Bob's Northwestern Mutual guy, and I'm like, you mean the people that sell the life? And to me, life insurance was you send $72 a month, and you have a $50,000 death benefit. You might have a little bit. They're like, oh yeah, he does all the premium financing and the buy-sell arrangements for their practice. I'm like, right. but you know, the guys that are serious about money are using this tool. I don't care whether you call it an investment or not.
Right.
They are using it because the banks will loan against it.
Right.
Because it is so safe. Because when you leverage it, when you go out and make a boring 5%, but you're using the bank's money, you end up getting higher than 5%, higher than 7%. You know, let us show you how the math works.
Right. So the wealthy leave clues. They know how to take their money and safely make more money.
Well, and they also know how to take other people's money.
Right.
Let it work for them. Let it earn interest. Get that OPC, that other people's capital, working for you.
I was going to say other people's cash. I guess either one works. So what's number 3?
Of what?
Just different positive
tax-free. This don't ask me anymore because I don't even work. No, I do, but
so number 1, safety. Number 2, the wealthy leave clues. Number 3, whole life insurance is tax-free.
Well, the wealthy leave clues
is also
there are different ways to structure this. That when I started sitting down with guys who owned practices that were bringing in 8 figures a year, car dealerships or small banks, and we start working with their CFOs and their CPAs, and we're doing premium. This is not your product pusher Prudential guy, which once again, despite what Dave Ramsey says, Prudential doesn't sell whole life insurance. What was our third one? Tax-free.
Tax-free, baby.
Why? The biggest lie perpetrated from Wall Street is that you should defer taxes on as much of your account as possible. You got to get that triple compounding. Okay. Triple compounding. I'm going to defer paying taxes on here. You're going to grow it at 12%. We know taxes are the lowest they've been, on a direct comparison basis ever possibly.
Right. But rarely do taxes go down.
Right. Taxes are here.
So why defer when you're probably going to pay even more?
Well, if taxes are going to go up and the value of your accounts is going to go up, and if the value of your account's not going to go up, why are you paying him for his advice? So that's the biggest lie. Defer. Would you borrow money from me if I say, hey, You don't have to pay me back or make any interest payments for 10, 20 years. But guess what? At the end of that 20 years, I get to decide what the interest rate is, because that's exactly what you've done in everything except your Roth, when your 401k and your IRA, your 457, your 429, your
I just thought of
403b,
something. Deferring
429.
taxes, you always say, is like an IOU to the IRS. Isn't that right?
Your IRA is an IOU
Dang
to the
it.
IRS. It's kind of a triple acronym play there, but yeah. So that's the biggest thing. So I think one of the biggest threats, other than the upcoming market crash, we're in a rising interest rate environment, is taxes.
Right.
So if you get to retirement, all your money is in a tax deferred account, and Congress raises taxes because we're looking at a $31 trillion debt, or if Congress raises taxes because the demographics to support Social Security don't work anymore,
Right.
and you've got all of your money in a tax deferred bucket, you are stuck. Oh, and you pull your money out of there, that creates taxes. Oh, now your Social Security is taxable. Your broker, your Main Street guy that is telling you to defer taxes and pump as much money as you can into your 401k, your IRA, or whatever it may be, unless it's the Roth. And I think you probably should max out your Roth. I don't care what you put it into.
You just don't want your broker to make you broker.
Well, we've talked about how it's such biased advice.
Right.
If you've got $1 million at your broker and he's charging you 1%, that's $10,000. If you convert it to a Roth and you have to pay 300,000 of that to the IRS, so your account's now worth 700,000.
Right.
Well, he only gets $700 a year off you now.
Right.
What's he going to tell his third wife?
As you can tell, Mark's very passionate
I've
about
dealt
the
with
subject.
a lot of Wall Street jerks in my time.
But you have done an outstanding job of explaining why whole life insurance is actually good.
And we are just taking the basic, setting it up as a whole life policy, maximizing it for cash value, being able to borrow for it. We haven't even begun to talk about the ways that we can turbocharge this. If you do this with a business,
Right.
Dave Ramsey says that people in the financial industry make fun of the Northwestern Mutual guy and the Prudential guy. Bank of America has more money of their own invested in whole life policies than they do in brick and mortar offices.
Yep. And that's
so who's being made fun of now?
Yeah, exactly. All right, wrap it up, Mark.
That's it. Like and subscribe, join us, find out ways you can protect your assets from the upcoming tax increases and the upcoming market crash. I'm Mark McKay.
And I'm Marcy McKay.
Have a great week.